Welcome to the part 2 of the volume spread analysis series. In the part 1, we had a brief look at the history of volume spread analysis or the volume price analysis. We also looked at the basic premises based on which the volume spread analysis is built. We looked at the 4 phases of market manipulation, namely the accumulation, markup, distribution, and the markdown. We also looked at the 3 laws of Wyckoff. In the second part, we will create some basic definitions for the practical use of VSA, and we will also introduce ourselves to the tools of VSA. In the first part, we saw that the VSA attempts to read the action of the smart money by reading the price action with close price, spread, and the volume. Now, there are actually 3 parameters, which is the close of the price, the spread, and the volume. Now, let's make some basic definitions regarding these 3 parameters or variables. First, let's look at spread. Now, what is spread? If you look at the standard OHLC bar, the difference between the high and the low is called a spread. Now, for the purpose of VSA, we have to define 3 conditions of the spread. One is the average spread, the high or wide spread, and the narrow spread. Now, if we calculate this value of, that is the spread for the last 60 bars, and then take an average of that, that will be our average value of spread. Now, if the current bar is 1.5 times the average value of the spread for the last 60 bars, then we will call it a high spread or a wide spread. Now, if the current bar is less than 0.7 times the average spread value, then we will call it a narrow or a low spread. Next, let's look at the close position. We will define 3 conditions for the close position. One is the up close, where the close happens in the top 30% of the bar. And if the close is between 30 to 70% of the bar, then we will call it mid close. And if the close is less than 30% of the total bar length, then we will call it low close. Now let's come to the volume. The similar manner what we did for the spread, we need to calculate the average of the volume for the last 60 bars. Here again, we will have 3 parameters. One is the average volume, high volume, and low volume. Now, the high volume is if the current bar is 1.5 times the average volume, then we will call it high volume. Similarly, if the current volume is less than 0.7 times the average volume, we will call it the low volume. Now, the number 60 is not a compulsory number. We took 60 because it represents almost 3 months of trading activity or a quarter of trading activity. But if one wishes, he or she can use a different number. Now let's look at the bar interpretation. Here we are trying to get more details or more information from the bar. So if you look at the value from high to close, we take it as it is representing the selling, because if the price has reached the high and it closed here, it was pushed down to this level through selling. Similarly, the value of close minus low, we take it as representing the buying. If the price was at low and it has closed up at here, that means there has been buying or demand which has pushed the price up from low to close. So we take this as representing the buying. So this is the selling or buying or selling pressure or buying pressure. So we take these as a rough estimation, and this is quite useful in our interpretations. Let's move on to the VSA tools. Like conventional candlestick definitions, in VSA, we will define some bars based on basic three parameters, namely the close, spread, and the volume. In candlestick analysis, we define certain candle patterns, giving some names like doji, hanging man, etc., and we interpret them as bullish or bearish. In a similar manner, in VSA also, we will define some bars based on the three parameters close, volume, and spread, again giving certain names, and we interpret them as bullish or bearish, or in VSA terms, we would call them signs of strength or signs of weakness. In candlestick analysis, we always need a confirmation in the subsequent bars. In the same way, in VSA also, any sign of strength or weakness would require a confirmation from the subsequent bar or bars. However, there is one important difference in VSA. The interpretation or the price action or the volume is dependent on the place of the bar in the overall price structure of the stock or the indices. So that is a big difference in VSA. Now let's quickly look at the signs of weakness and signs of strength. The signs of weakness, or SOW, as in a short form as we call it, are the upthrust bar, pseudo upthrust bar, effort to fall bar, buying climax, no demand bar, two bar reversals. Similarly, we have the signs of strength, or the SOS, are the stopping volume, effort to move up bar, reverse upthrust bar, selling climax, no supply bar, test for supply, spring, push through volumes, and two bar reversals. In the subsequent parts of this series, we will be looking at these signs of strength and weakness in detail. We will look at what are the definitions and conditions for these signs, how to interpret these in detail, and what to look for. Let us now move on to the last part of this video, which is market structure. In VSA, understanding the market structure is very important, as the market structure presents the trade opportunities. We saw in the last part that the Wyckoff market cycle has four phases: the accumulation, markup, distribution, and markdown. So if you know or understand there is an accumulation going on and it the markup is beginning, then that is the right time to enter. And any accumulation part, you need to wait for a breakout to enter. So these are the different opportunities which the market structure presents. In addition, we also need to identify the consolidation areas, identify where the price are being rejected or the price rejection zones, and identify the price support zones or where the price is getting support. So these will help us to find the correct trading opportunities. Now, from the chart, we will look at how to find out the price rejection and support zones. Now, let's quickly look at how to identify or draw the price rejection zones. Here, I have the chart of ABB on TradingView. As we can see, the stock was going up, and at this point, there's some resistance, and the stock could not move further, and it came down. So there was a price rejection which happened here. We all know the stock market is an auctioning process where there is a bid and an ask. So if the bid price is acceptable to the buyers, they will buy it. Otherwise, they will not buy it. So at certain point, the buyers feel that price is not justified and they don't buy the stocks. There's no demand and the stock comes down. So I will zoom in further here. For clarity, I have zoomed in here. As you can see, there is a series of up bars and down bars and up bars and down bars. Here, there was an up bar, then a down bar. Then it was followed by a widespread down bar. So there is a price rejection happening here. So this price, or this close, was not acceptable to the buyers, so they quickly rejected it and the prices came down. So let us look at what was the last price which was acceptable to the buyers. So the previous up bar here, you can see this price closed here. It closed at 2389. There was a down bar here, but here again the prices went up. It closed here. So this was the 2389 was the last acceptable price. So let me draw a line here where the price rejection happened or where the last price was acceptable and any price above this price was rejected. So the prices went up to this level, went up to 2468 but got rejected. So our last acceptable price was 2389. So let's mark it here. $2,389. And what was the uppermost price which the stock went to is 2468. So I will mark that as well. So the price was rejected in this zone. So we will mark it as our price rejection zone. You will see this price rejection zone comes into picture again in future. So let me extend this price rejection zone here. As you can see here, the price went into the price rejection zone, and there was an attempt to break out of this price rejection zone. So in this bar there was supply and it followed by further supply and the stock came down. So it could not take out the price rejection zone this time. So let me extend it further. As you can see here, this price rejection zone was clearly taken out by this widespread up bar. In VSA terms, we would call it jumping across the resistance. So it did not pass into the price rejection zone, it clearly jumped across the price rejection zone. So this would have provided as a very good opportunity for a trade, a long trade, and this is the right time to enter and you would have made good money. So this is how we identify and draw the price rejection zones. Now let us quickly look into the price support zone as well. The stock price, after getting rejected here, it started coming down. It reached a low here, but the lowest close was on this bar. I will expand it or zoom for more clarity. See, the lowest close was on this bar. After this close, you started getting support. As you can see, immediately the stock moved up. So I will start drawing the zone here. This was the last close and the lowest price reached was on this bar. Let me quickly put the values here. This was 2025 and the boundary of the zone is 206. So this is our price support zone. Let me mark that as well. Price support zone. As you can see, the support zone came into picture again in this bar. Let me extend it further. Again here, the support came at these levels. Here, of course, there was a temporary excursion outside the zone, which in VSA terms we would call it a spring, which we will be covering in later part of the series. I'll extend it further. Here again, the same zone gave support here. And the stock started moving up. So this is how we draw the price rejection zones and price support zones. These are very useful to identify opportunities for trade. We will be coming across these price support zones and price rejection zones in the future parts of the series as well. So there will be more clarity coming from that time. With this, we come to the end of this part of the video series. From next part onwards, we will be covering the signs of weakness one by one in detail. So in part 3, we will be talking about the buying climax or the magic of buying climax. In order to get notified for release of the future parts or the videos, do subscribe to this channel. In case you find this video useful, please do press the like button.